With all the big buzzing business news of the day, I'm Vikram Oza with this latest edition of Business at 9 here on ET Now. I'm tracking crude oil prices and now seeing them come off the kind of losses that crude made after OPEC Plus has announced that 2-month pause in any kind of hike in production output. And on the back of which we've seen crude oil prices rise 2%, trading above $70 to the barrel. Remember, OPEC Plus initially planned to hike 180,000 barrels a day in October. Meanwhile, U.S. crude oil inventories have fallen 6.87 million barrels for the week ending 30th of August. Now, the question that this begs is, are we going to see a healthy recovery in demand for crude post this announcement, this decision by OPEC Plus? And what will be the impact of this recovery in crude on the Indian market or emerging markets? To get an understanding of this, let's connect with Geoff Dennis. He's joining us on the phone line, an emerging markets commentator. Geoff, always good to have you on the show. What's your reading of OPEC Plus's decision now to stall the hike in production by 2 months? This has definitely had a knee-jerk reaction on crude oil prices, which were on a very slippery slope. But do you think that they will keep rising, these prices of crude oil? Do you see an elevation that can sustain?
I suspect what's happening here is they're actually forming the bottom end of a trading range. I think it was inevitable at some point that OPEC Plus would delay this output increase because there've been several factors pulling crude oil prices lower in the last few weeks, including worries about the U.S. economy, worries about the Chinese economy, expectations that Libyan oil will come back on stream shortly, although that's not a big factor. And, of course, U.S. inventories have been pretty strong. Two of those factors have now reversed. One is, as I say, the inventories, and now we've got the cancellation of the OPEC Plus output increase, at least for now. So I think those are the factors that drove the prices down. This is what's causing the rebound. And I suspect we've probably hit bottom for the time being, and we're beginning to form a bit of a trading range here.
What kind of trading range do you expect crude oil to be in, Geoff? The kind of commentary that's coming from China, the largest importer of crude oil, now that still stands. And if that is the demand-supply situation, and this is a product, the kind of crude oil slide that we're seeing in its prices is a product of, demand-supply, then where does that kind of take crude oil prices in what kind of range?
I suspect the range for Brent is going to be something like 70 to 80 or 85 in the next, say, 2 to 3 months. One or two things you can't turn around in terms of pressures to the downside on prices. One is the Chinese economy is struggling and is struggling very much, and there's no obvious reason why that growth rate is going to turn upwards in the near term. And also, although obviously the U.S. economy is in reasonable shape and ought to avoid recession, at least as far as I'm concerned, I think the chances of an acceleration of growth in the U.S. is relatively limited. So I don't see a big surge in prices here. But I think, as I say, I think prices got oversold. And when you get oversold like that, you get an output adjustment from one of the key suppliers, and that's the OPEC Plus group.
This is coming on a day that some positive data is coming in on the jobs front from the U.S. Now, of course, as far as rate cuts are concerned by the Fed, that entire notion is what the markets, or at least Wall Street, is building on. How do you see this impact the kind of sentiment that would sway the markets, Wall Street in particular?
Well, ADP was very weak. I think the market will ignore that, or at least will quickly focus away from that to the payrolls tomorrow. The unemployment claims was pretty neutral, I think. At least it didn't show a rapidly weakening labor market. So all eyes will be on tomorrow, and I think the next move in Wall Street will be determined by what happens tomorrow. At the margin, I guess higher oil prices are a slight negative for equities because they run the risk of pushing inflation a little higher, were that to be sustained or extended. But frankly, the impact on on what the Fed is going to do is going to be finally be decided, I think, by the payroll numbers tomorrow. I said 24 hours ago I thought the Fed would cut by 25 basis points in 2 weeks. I think now the chances of 50 basis points have increased because the labor market clearly is weak. We'll know more about that, obviously, tomorrow. Elsewhere, I think in the emerging markets, a rebound in oil prices of this sort is small. It's small relative to the big decline we've seen. So for India and Turkey and Korea and Taiwan, all of whom import all of their oil effectively, I think it's been a big benefit in the last few weeks, the fact that oil prices have fallen so far. And I just wouldn't get too excited about a $2 rebound because it's bouncing off the bottom and there's still very low prices relative to the long-term trend. And oil importing countries should be happy with that.
Well, we'll keep tracking crude oil prices, and of course, we will be checking in with you as well. But for the moment, thanks very much for joining us with your perspective on what we are seeing on Wall Street as a result of.
If you like this video, then like, share and subscribe to ET Now.